double digit?
I think we have a chance at that for sure. I mean, earlier in the year, I thought we would hit 7,000 and stayed there. We haven't managed to do that yet.
Oh, come on, we've pulled back 3 or 5%.
Well, 3 or 5%, but the expectation for the year was around 7% return. So yes, Tom, we might get to that 10% or more for this year. But, the broader backdrop is supportive, right, on a number of different factors. The consumer side, I think, is actually strengthening this year as we speak. The other notable development for me this week is all about capex. And capex not only in the United States and not only from hyperscalers, but capex globally. We've got the European manufacturing numbers came out this morning, and those popped quite significantly, driven by German fiscal stimulus. So, back to kind of the U.S. economy, though, capex also is an engine now. And then housing, maybe that'll pick up too.
Yesterday, Paul, was way too optimistic.
Yeah.
I mean, I'm
Sure.
sorry. There's like an optimistic tone going on.
There is a little bit. Good earnings out there. Anastasia, I'm looking at the WEI function here for the world equity indices. The U.S. is doing fine as it did last year, but the rest of the world's doing better.
Right.
So rest of world versus U.S. outperformed by and large last year.
Yeah.
Same this year. How do you view kind of where to allocate geographically?
Right. I think the way we see allocations is that you don't pick one or the other. You do both. You do U.S., you do Europe, you do Asia. And the reason for that, if you think about the next 5 years, let's say, it's all about localization of supply chains. It's onshoring. It's about, making sure you cater to the domestic consumer. So it used to be that you could allocate to a U.S. multinational and that would get you the Europe exposure or China exposure. That's no longer the case. So that's why I think you have to invest in each specific region. But to bring it back to sort of the cyclical momentum, I think the reason why Europe is actually seeing an outperformance versus the U.S., because the U.S. has this rolling AI scare. Maybe it's software names, maybe it's wealth tech names. And so the AI exposure has not been a positive to the market. But I think even beyond that, there is something positive happening in Europe. It is the German fiscal stimulus that I mentioned that is showing up in the manufacturing momentum. It is also the fact that Europe is striking deals of its own. 50% of global GDP is covered by some sort of a trade deal with EU now, the latest one being with India. So that's a big deal. And then you have this bifurcation between the Northern Europe versus Southern, and Southern being more services oriented, consumption oriented. So that's holding up well too. So we've always liked Europe. We invest about 39% of some of our solutions in Europe. But I think there's this cyclical upside to it as well now.
In the U.S. market, we've seen a pronounced rotation starting, I guess, in late October, November. Is that a short-term trade, or is that something more prominent, do you think? Or because we've in the U.S. market, it's always been led by tech, but there seems to be rotation a little bit.
I mean, it feels a little different to me this time, and no, I don't think the hyperscaler trade is gone. I don't think the semiconductors are not going to perform, but I do think there's this realization that for the last maybe 10 years, it's been software's world, and we've all been living in it, and software was eating the world and so on. And it's been sort of, the business model that's asset light, that's what's benefited. But as I think about going forward, it might be that we're in the asset heavy economy once again. It's about physical assets, tangible assets that can be made obsolete by the stroke of AI overnight.
You were brilliant on this at New Mexico years ago. Let's bring it in. What happens to your world if the hyperscalers decide to grow up and actually issue debt like Google did the other day? I look at that, Zvibodi 101 up at BU, and it's just got to be a plus for confidence.
Well, that's right. And the reason why they're confident to do so is because they have the free cash flow to do that. And, although to Paul's point, the markets were fearful and the spreads were somewhat widening, back at the tail end of last year, the realization is they have hundreds of billions of free cash flow and, just cash on the sidelines, so they can afford to issue that debt. The reason, Tom, I think there is such a great deal of confidence for hyperscalers is because they do see the future potential growth in their cloud revenues. And whether it's Google, whether it's others, you see that hockey stick inflection higher in cloud revenues. That's important. They also see the revenues of their customers, the likes of OpenAI, Anthropic, and others, and those have been going up substantially as well.
Earnings were, about 80% of the way through the S&P 500 reporting earnings. They look pretty solid to me. Are they enough to support this market here going forward?
They do look solid, absolutely. And, I think what's actually really interesting too, Paul, is that even earnings for software companies that we've worried about also look solid. We'll look through a number of software companies and 60% or so of them reported, and 80 to 100,
Right.
depending on the sector, have reported positive earnings surprise and earnings growth of 20 or 30%. So that alleviates some fear in that particular pocket of the market. And then beyond that, for the market in general, take a look at the profit margin. It's going up. It's gone up despite tariffs, and we're looking for a record 13.9% profit margin. That's likely driven by AI.
And we may get, did Tyler say we may get the Supreme Court thing today?
Could be, yeah. I mean, they're definitely going to
Does that get in the way of the hockey games?
Oh,
I
boy.
hope not.
I hope not. I hope not.
We don't want that.
We don't want that. Anastasia Amoroso, we continue with our Chief Investment Strategist. Partners Group nailed the bull market to be direct. Is this the Partners Group of Switzerland?
Yeah.
It is.
Have
the
you
Partners
been
Group.
to Zug?
Of course, yes.
A
yes.
bowl of soup costs $40 in a restaurant?
It's quite a lot. It's Switzerland.
Do the Swiss want to buy America? Because we've had different people saying, well, people are sort of upset with President Trump, but they really want to buy America. Do the Swiss institutions and continental Europe institutions, do they want to buy Microsoft?
Look, I think the realization for all institutions globally is that you might disagree with the current policies, you might disagree with the current tactics, but not to invest in America is not in investor's best interest. You think about the corporate tax rate and, again, the fiscal stimulus that we have coming out of the U.S., you look at the innovation, you look at the margins, you look at the productivity gains, it's really difficult not to allocate capital here. I will say one question mark for investors has been around the direction of the U.S. dollar. And if the dollar weakness continues, does that actually eat away at your returns significantly? We're of the view that, we're at a point where there should be some more stable conditions between the euro dollar, for example. So with that as a backdrop, the capital flows definitely should continue to the U.S.
What are we doing in the bond market here? I can sit in a 2-year treasury and get 3.5%. Are you suggesting your clients take credit risk above and beyond that?
Yes, I mean, for a more risk-averse individual, perhaps looking at the shorter term of the U.S. curve might make sense. But we're also investors in private credit, and private credit, despite the headlines that are out there, we see fundamentals that are still quite solid. I can elaborate on that in just a minute. But we also see the yields that have come down from 12%, but they're hovering, let's say, around 9 or 10%, which is still quite attractive in a world where rates elsewhere are going down. Now, back to the solid fundamentals of private credit. First of all, default rates are holding steady, and they're quite low. They're also bifurcated. If you're in the cyclical industry like autos, yes, you're going to see a higher default rate. If you are a non-sponsor-backed credit, you might see a higher default rate. But if you look at the sponsor-backed, especially secular growth credits, we're looking at a default rate of 1.5%, which is quite low and quite normal. So, and even in software, Paula, I would say for private credit, we're still seeing a default rate that's half what it is for the index. So a lot of the noise that's out there is noise, and I think investors would be well served to take some risk in private credit.
You mentioned software. We've seen such a rotation out of software stocks as part of that AI concern rippling through the market. Is it time? I mean, a lot of these names, you're like, boy, I always wanted to buy them, but they were too expensive.
Yeah.
Is now a time to, boy, I hate the falling knife scenario, but it seems like some of these names are pretty attractive.
I think some of them are, but that's the key word there is some. I wouldn't necessarily step in and buy the full index or the full ETF because some parts of the software universe have sold off, rightfully so. First of all, if you looked at the valuation before, the valuation was based on annual recurring revenue growth that would assume to be X. But now that ARR growth has come down for a lot of those names, and maybe it's not ever going to get back to those 2021 levels because of agentic AI. So are you going to pay the same multiple, or is the low multiple attractive if you have lower revenues? Maybe not. I wouldn't step in there, but some incumbents are worth looking at.
My essay a couple years ago, Lawrence McDonald was just brilliant on the absolute wall of money that has to find a place to go in investment. It's still there, isn't it? After the Amoroso bull market of the last 5 years, I mean, it's tax season now. I mean, pick the calendar date. You know better than me, Anastasia. There's just this wall of money that's got to find a place to go, right?
There is. And it's really coming from a lot of different places. If you think about kind of the consumer side of it, this year in particular, we're looking for higher refunds. Some of it will 24% year over year. Some of it will find its way into consumption, but some of it will find itself in investing. if I think about the institutional capital worldwide, you have some of the sovereign wealth funds that are benefiting, for example, from continued sales of natural resources. And so you have that steady stream of revenue that's finding its way into the market. And then, if you think about corporates, and we talked about margins, we talked about the cash accumulations, that too is adding to it. So, maybe Tom, kind of the extension to your question, well, is there too much money, and especially in private markets, chasing some of these deals? And yes, there's an increasing amount of capital, but I would say there's an increasing amount of opportunity as well.
Yeah.